Hello, everyone. It's as we approach the end of the year, 2024. It's been just a fantastic year for multifamily investors across Canada. I guess it depends on where you are, but at least in the prairies, it's been amazing. So today, I just want to talk briefly today, short video about the different types of multifamily. So everyone knows, if they know me, they know that I love this asset class. And the main reason that I love multifamily is simply for the economies of scale. I can increase value quickly or, inflationary over time. There's less risk involved because one vacancy doesn't, completely, sink you if you only have a single family unit. So there's less risk. It's a lot more stable. So if you do it right, it's pretty hard to lose. But, these assets, they are not all created equally. So basically, today I want to talk briefly about the three different types. Okay. So you've seen, I'm not going to talk about MLI Select or new construction or any of that, crazy shit that's been on Facebook nonstop. So this is just basically the bread and butter of it, of multifamily investing 101. So I talk to people every day. I talk to real estate agents. I talk to real estate investors. I'm part of, many masterminds and clubs. So, I mean, I'm on this all the time. I mean, I'm looking at probably anywhere from a dozen to 15 to 20 listings a week. So, I crunch the numbers and look at pro formas all the time. So I can tell you, basically, the three categories are newer construction. I'm not talking about new. I'm not talking about builds. I'm talking about newer. So anywhere from like 2000, 2005 to 2023, 2024. Okay. And then there's the stabilized. So if you can find a renovated building that someone has put a lot of work into it, they've put a lot of money in, they've fixed the major components, and then they're ready to sell it. And I bought several of these. This is probably absolutely my all-time favorite type of asset. And the last, of course, is the value add or the BRRRR. Okay. Um, which seems to be what everybody wants. And I think this is like a big mistake. And I'm going to give you a few reasons why. When you look at a realtor pro forma, you can usually easily pick out a value add or a BRRRR because they'll have a projected column for the rents. Okay. They're calculating all the pricing, not based on the actual expenses or income of the building. They're using industry standards, CMHC numbers, and a projected market, usually from the CMHC rental market report, to come up with a fictitious, often ridiculous version of value for this value add project. Typically, it has very high vacancy, rents are low, and it needs a ton of work. Usually 30,000 a door in renovations, plus you got to get interim financing, very, very expensive. So generally speaking, unless you can get it 40, 50 a door, you know, less than what you would otherwise, it's simply not worth it. Now, I have done a few of these. It's a lot more difficult today. Rates are higher, original costs are higher. Renovations are really expensive now, so there's a lot more risk in doing this, and I honestly wouldn't do one today unless it somehow landed in my lap. Newer is great. I mean, I'm looking for assets like this myself. This generally comes in larger buildings, like 50, 100 to 200 plus. Now, economies of scale work kind of funny with multifamily. You get up to that, 6, 12, 15, 20, 24, up to 30 units, and the price is pretty much the same. But as soon as you get to 50 plus, and especially when you get newer, the price starts to go up. So economies of scale start to work the other way. They start to get more expensive. And this is also a lot more competitive space. So this is where most of the big money or the smart money is after. Okay. So they're chasing after this is REITs, pension funds, etc. Now I've seen a ton of these buildings that have come out recently that have been sold. Very high prices. I mean, you're talking anywhere from 4, 4.5, maybe a 5 cap rate, if that. So it's not even enough. Most of these projects will not qualify for 5-year CMHC money at 85% loan to value. That's full leverage you can get with CMHC. Most of these projects just wouldn't qualify. They're being acquired by pension funds or REITs, that can purchase with 50% leverage, 40% leverage for the cash flow so they can give their monthly distribution. Okay. So, cap rate's not as important to them, although, you should be calculating a spread between what you're borrowing and the cap rate. And in this case, yeah, it's really skinny, man. Like you're borrowing at about 4% today, And if you're paying at a 4.5 cap, your return on what you're borrowing versus what your yield is almost nothing. So very different type of investment. But you're going to get the top rents and you're going to get, the best tenants. You're going to be at the top of the market and you're going to have very little deferred maintenance. You're not going to have to fix a bunch of things. Okay. So that's the advantage over the burr. My personal opinion, my favorite is the stabilized building. I bought a couple of these and I can tell you, you get a good return right off the bat. Usually, the rents are a little bit low, so you can get a bump. If you have a turnover, you can easily fill the unit because the suites are renovated. The roof has been done, the boiler's been done, and everything's been done, and it generally looks nice. And you can buy it for, you know, two-thirds, half to two-thirds of new construction. So even of these newer projects, they're significantly cheaper, and they're usually in mature areas. They're close to transportation, et cetera. And I'm going to show you an example here of exactly what I mean, and I'll show you where a lot of the new stuff is and why I generally don't try to do that space. So with that, I think that was all I wanted to mention for now. But yeah, I'm going to just share my screen and I'm just going to show you. So I do have a building for sale. So this is partially, I have an ulterior motive to making this video because I do have a building that I'm selling. This is a 24-suiter. This is a joint venture that I acquired back in 2015, I think. So I've had this building for, close to 8 or 9 years. And, we've done well on it. We bought it right. But I've spent a lot of money on this. I've spent probably $500,000 or more, 20,000 a door maybe. But now it's a premium building, and I'm going to show you why. I think these assets is something that you should really consider. Okay, I'm just going to share my screen now. Okay, so this is the project. Okay, so this is 3609 Shaven Place. I'm just going to turn my head this way because this is where my screen is. So this is a premium building and it's in a premium area of Saskatoon. So it's on the east side. I'm going to show you on Google Maps in a second exactly where it is. This is one of the rare buildings that will qualify for full bore CMHC. It's almost non-existent that I see a listing pro forma from a realtor that this building will qualify for 85%. It almost never happens. Okay. So usually the rents are lower. There's something else going on. So this is very good project for someone who's from out of town, maybe from the east or maybe from Vancouver, maybe the lower mainland, that just wants a good project at a decent price and a good return, over time. And I think the Saskatchewan market is going to do very well over time. We got a ton of in-migration there. Rents are still low, like very low compared to the rest of the country. So there's still a lot of upside for someone who wants to buy. It's professionally managed, and Saskatoon had the highest rent growth in all of Canada in 2024, according to the latest rental reports of 19% year over year. I think those were November numbers, and I expect the December rentals.ca numbers to be about the same. So I'm going to go over the pro forma on the left on a separate slide or a separate window because it's kind of hard to see on this one. But I'm just going to give you the bullets here. It's been upgraded. So with our rent increases we've already given out, which are effective for June, our rent roll is going to be 32,125. So that's a 24-suiter. That's pretty good for a 24-suiter. I've seen a few of these buildings listed in Edmonton. The rents are nowhere close to that. The Saskatoon market, according to CMHC rental report that just came out, is sitting at 2%. So Edmonton's like 3%, and I think rising. I think Calgary's even closer to 5%. So yeah, I think rents are going to taper off a little bit in Alberta, but I think Saskatchewan's got a longer runway. I think we're going to have, at least another year of solid rent increases, probably 10%, another 10% increase in 2025. Very low vacancy, 1%. So obviously the slide's old. I just checked the numbers this morning. It's actually 2, so it's gone up a little bit. But yeah, I actually had a lender, CMHC lender, help me to underwrite this building because I was going to go for a refinance. That was my original purpose. And then I decided, you know what, this is going to be a good asset for someone to buy. So it's basically been kind of CMHC rubber stamped for ease of qualification and financing for someone who wants to step in. As I mentioned, rising rents. It's still the hottest rental market in the country. If you check any rental report, any news article, that kind of thing, mostly these statistics, will show that. And it's still because it's out of 35 major centers, it's still like 34th or 35th in rents. So I mean, everywhere else in the country just went bonkers. Saskatoon is just slowly catching up. Very large suite sizes. It's got a great suite mix, 17 two-bedrooms, which is fantastic. Um, a very large lot. So there's a potential here to build if you want to do some development and premium location, which I'm going to show you shortly here. So here's the rents. We have 17 twos, 6 ones, and one bachelor. So on the left-hand column, this is the market of these surveys that we do about every month. Okay. So we're already getting close to the market rent here. So we're, 1450 for a two, 1250-ish for a one. So we're very close to this rent roll right now, which is why this, pro forma I've done up is pretty accurate. I mean, you could go to the bank for this now and get a loan for this project, 85% of the almost 4 million that I'm asking for this building. So, here's the rent increases. So in green, these are the increases that are coming into effect. So to get 32,125. And on the right, so here's the rental market report. So this is where it shows, you can't really see here, but Saskatoon is 34th, only behind Fort McMurray in terms of where rents are. So a lot of room for growth. And yeah, pretty pumped for that. Even Calgary here, rents are coming down in Calgary. So Saskatoon's got a ways to go. So this is just a snippet, from that report, from that rentals report from October of 2024. Continued to post double-digit growth. Saskatoon, 18.9%. Lloydminster, Alberta had higher, but it's a smaller town, oil town. There's way more risk involved in investing there. I used to live close to there. So, here's the numbers there. So Point Claire, Saskatoon, Lethbridge, Medicine Hat. These are all smaller areas. Obviously Halifax had a big boost, but Saskatoon significant. Even above, well above Regina and well above a lot of these other smaller mid-sized cities. And yeah, number 24 on the rentals list. Here's just a shot of the title, so you can see the kind of the shape of the lot. Now I think it was like around 30,000 in landscaping. Yeah, almost 30,000, 26,000 in landscaping. So this, I put trees in, irrigation, everything. This place looks like $1 million, like looks like 4 million bucks. But it's literally the best looking building on the block. So we're getting the best tenants, we're getting the best rents. So it's the good news. Everything, all the windows have been replaced. They're all new. That was about 40 grand. And I've done a ton of suite upgrades, as you can see. There was a new peaked roof installed. So you don't have to worry about flat roof ever. The building's got, I think, 20 years left on it or something. Just an amazing property. So here's just a look at the landscaping. So here's all of the trees and shrubbery that I had put in and everything. So it looks really good. We're gonna see if we can see some of that on Google Maps. Here's just a couple of the photos. Here's one of the suites on the right that we just renovated. So the bottom left here, you can see the size of the lot. It's just pretty large. And here's the view from the front. And the bottom left is kind of showing the overview. This is it in the bottom left corner. So you can see just the sheer size of it. So very big lot, just surrounded by other multifamily. So yeah, there's my contact information. I'm going to leave it in the link in the video here on YouTube. So you can feel free to connect to this and download this for your own needs. It'll ask you for an email. I also have a confidentiality agreement that you can sign to get a full drive that has a lot more information. So here's the pro forma. I'll just quickly browse through this. So on the left-hand column, so these are the kind of the stats. There's the plan. I do have 2 sets of laundry there, for these 24 units. It's on 3 floors. College Park in Saskatoon, one of the most premium areas. So here's a few of the things that I mentioned with the upgrades. Here's the suite mix. Proposed financing. So this is basically based on the loan. I think as of today, these numbers are pretty accurate. I've been watching the bonds. They've kind of been floating around. So you're going to get a loan of about 3.4 million. It's about 600 down. Your payment's going to be just over 14 grand a month. So 170,000 a year. Okay. Now, if you look at the income and expenses, this is the actual income plus the rent increases that have been handed out. So there's our gross annual. I used a 3% vacancy, which is actually way higher than what the actual vacancy is, just to be conservative, to give you an effective gross of, almost 379. And these expenses are actually real expenses. I mean, I've seen some crazy ones from realtors that are like, 4,000, 5,000. These are stabilized actual expenses of what the building is actually costing me right now. So it's about $6,200, 6,300 per unit, which runs about 40% of the income, which is pretty standard on a stabilized, well-operating apartment building. If it's kind of run down, really high expenses, really high repair and maintenance, this number is going to be closer to 50% expenses. Okay, so this is how you know that the building is stabilized. And on brand new, or where there's low deferred maintenance, top rent, this number is going to be more like 35 or even 30 for expenses. So just kind of keep that in mind. Cap rate 5.75, which is really good for this area and this type of asset. So if you take the cash required of 600, the cash flow after debt service, so after you've paid your mortgage, so the net here is 229, you're going to be left with almost 60 grand at the end of the year. So you divide that by 600, it gives you almost a double digit return, cash on cash, which is pretty good nowadays, right? And then when you add down your principal, you're getting almost 16%. So total return per year. So, over 5, 10 years, you're going to do well. Debt coverage ratio. So this is the net operating income divided by the mortgage payments. So you need 1.3 DSCR for CMHC 5-year money. This building easily qualifies for this. And if you wanted to go 10-year, you can do a 1.2. So it would actually qualify for even more. Although you're not going to be able to borrow more than 85% of the purchase price or the appraisal, whichever is lower. Okay, so on that, I'm just going to give you a brief lay of the land here. So for those of you who don't really know Saskatoon, this is the area that is located here in the red dot. But I'm just going to zoom out now. Hopefully, I'm still sharing this. I'm just going to zoom out now. Um, Bear with me for a second here, because that circle disappeared, but I think we're still good. Okay, so when I zoom out, here's Saskatoon. So the newer areas down here in Stonebridge, it's gotten a lot bigger now, but you're way out of the outskirts. The main drag for Saskatoon, here's the downtown area, but 8th Street East is kind of where the action is, right? So if you go across the bridge here, you come down across 8th Street. I just sold a building actually that was right about here on Broadway and 8th Street. But as you travel over, you can see, you know, just everything that's on there. So the center of Circle and 8th is a very busy intersection. You got the center of Circle and 8th Mall. You have a big movie theater here. You got like a shopping here, groceries, just about everything you could possibly imagine. Bus access, really good walk stores. You got a major mall right here. Probably out of all the buildings I've ever owned, as for location goes, this is probably the best. I don't think I've been fortunate enough to own a building in an area like this. So I'm just going to go on the maps here and just show you a brief look at what it looks like. I don't know how old these photos are. This was done before the landscaping, so you're not really going to see much on that. But yeah, so here's Chabon Place when you come in, and there's a few other surrounding apartment buildings. But here you can see the 24 units. And I'm just going to move over here a little bit more. Yeah, so the building is kind of laid out like that. Let's see if I can get on as far as I can on this side. And it's pretty tough to tell from Google. But anyway, that kind of gives you an idea. I do have a lot more photos in the drive. So if you're interested in having more information, feel free to check that out. So on that, this video ended up being a little bit longer than I wanted to, but I really want you to strongly consider an asset like Chabon Place, because I really believe, with what I told you about newer stuff versus older, value add, I really think this is the way to go. In fact, I'm even potentially, going to keep this asset and refinance it, convince my investors, because now it's generating a good return. We've had very stable cash flow on this building. We've done all the work. We've done all the renovations. So your expenses are not going to be like that way. The building is positioned. So hopefully you consider that. And I hope you enjoyed this video today. So please like and comment. I'm going to send this out an email, so please respond on the email too. I love doing this. I love giving back, sharing my advice and my expertise in this area that I'm incredibly passionate about. So I want everybody to have a fantastic Christmas and Happy New Year, and I will see you guys in the next video.